This week has the potential to become one of the most powerful moments in XRP's history. And the surprising thing is that many people still don't realize what is unfolding. What is happening right now is not a normal update, not a random market move, and not a typical piece of crypto news. This feels like the moment when XRP quietly shifts from being a digital asset discussed by early believers to becoming a foundational part of the new global financial structure. And before we go deeper into this transformation, I want to welcome you to our channel, the place where we break down complex financial changes in simple, easy-to-understand language so everyone can benefit. If you want to learn how the future of financial systems is forming piece by piece, you're exactly where you need to be. Imagine looking back months or even years from now and realizing that this week was the turning point. The moment when major institutions began positioning themselves aggressively for XRP exposure before the general public even understood why. When giants like Grayscale and Franklin Templeton move together, it is never by accident. These firms are known for their strict risk management, slow decision-making, and careful strategic planning. They do not chase hype, they do not follow emotions. They act when they see a direction the world is moving toward, even if most people can't see it yet. And because both of these giants are preparing to enter the XRP spot market at the same time, it tells us something big is happening behind the curtain. Before going deeper into the numbers, projections, and institutional behavior, the numbers this week are shocking. The ETF projections alone could pull nearly 50 million XRP out of circulation in one single day. Canary is estimated to acquire around 5 million XRP. Bitwise could take another 5 million. Franklin Templeton may accumulate 15 million, and Grayscale might acquire around 24 million. Even though these are projections and not guaranteed outcomes, the simple fact that institutions are preparing for this level of demand at the same time shows that this moment is far bigger than a retail-driven hype cycle. These are regulated institutions working under strict rules and heavy compliance. They do not make random moves. They plan, prepare, and accumulate in advance. There's also been confusion around dates. Some people thought Franklin Templeton's CBOE listing on November 18th was the full launch, but that was only the listing phase. The real impact begins when the New York Stock Exchange opens trading for both Franklin Templeton's product and Grayscale's GXRP. The NYSE is a $30 trillion market. It opens XRP exposure to a massive network of brokers, funds, and advisors who previously had no regulated pathway to invest. This is what makes this week uniquely important because the moment these ETFs go live on the NYSE, the level of attention, trading volume, and narrative momentum around XRP shifts dramatically. All of this is happening right before Thanksgiving week, one of the highest volume news cycles of the year. That means more media, more coverage, and more eyes on XRP than we've seen in a long time. And institutions are positioning early because they understand what most people don't. When a new financial system is forming, the people who position first benefit the most. This week might be remembered as the moment when XRP finally stepped onto the global financial stage. The projections we are seeing right now are not random figures pulled from thin air. They come from real patterns and real institutional behavior that has already appeared in the market. To understand why this week could become a key turning point for XRP, we need to look at what these numbers really represent. Earlier this month, Canary Capital's XRP product launched, and on its very first day, it saw nearly $59 million in volume. That single day represented around $25 million XRP trading through their system. And remember, Canary is small compared to giants like Grayscale and Franklin Templeton. So when you take this early data and apply it to much bigger institutions, the idea of 50 million XRP being bought in a single day does not sound unrealistic. In fact, it sounds conservative. This is why many experienced analysts are calling this the early stage of a major liquidity squeeze. A liquidity squeeze happens when demand increases at a pace that supply cannot match. And because XRP has a fixed supply and limited circulating volume, sudden waves of institutional buying can create powerful price pressure. But while the price is important, the real story is about what causes this kind of demand in the first place. These institutions don't buy assets for emotional reasons. They buy them because they see a future in which these assets play a structural role. And right now, XRP is moving into a category where its utility is becoming attractive to the biggest financial players in the world. At the same time, we're watching the futures market explode. BitMEX recently saw a more than 2,000% surge in XRP futures trading activity. That's not a normal number. That's the type of spike you usually see when big players are gearing up for a major event. On top of that, Binance, Kraken, Bybit, OKEx, and other major exchanges are showing strong increases in open interest, leverage long positions, and aggressive futures buying. This usually means traders with deep pockets believe something significant is about to hit the market. Futures activity rarely moves this sharply without a strong catalyst behind it, and the upcoming ETF launches give us the perfect explanation for this behavior. But the truly important part is understanding who is behind these moves. Franklin Templeton is not a small organization. They manage over $1.5 trillion in assets, and they do not experiment lightly. Before they launched their XRP ETF, they had only launched one other crypto ETF, a Bitcoin spot ETF back in early 2024. They didn't scatter their attention across different coins. They didn't create a long list of altcoin funds. They studied the landscape, evaluated the risks, and chose XRP as their next major product. That alone tells you something about the direction institutional attention is moving. When a trillion-dollar asset manager enters a new market, they bring their entire network with them. Franklin Templeton works with sovereign wealth funds, pension funds, global banks, insurance companies, and private equity giants. These clients don't think in small numbers. They think in millions, tens of millions, and sometimes billions. And what most retail investors don't fully understand is that when these ETFs go live, Franklin Templeton's advisors will begin recommending XRP exposure to their clients. This creates a ripple effect. More interest, more demand, more buying, and more liquidity entering the ecosystem. Now think about the timing. The NYSE launch is happening right before a major holiday cycle, which means the financial media will be full of market coverage. Crypto news spreads faster during these periods because people are actively watching markets, planning end-of-year strategies, and preparing for the next big trend. This creates a perfect environment for powerful narrative momentum around XRP. When something gains attention at the right time, the effects multiply quickly. All of this leads us to one clear conclusion. The institutions moving into XRP right now are not doing it casually. They're preparing for what they believe is the next phase of digital finance. And retail investors, who often react emotionally or focus on short-term price moves, can easily miss what is happening underneath. This week is shaping up to be more than just a milestone. It might be the moment when institutions publicly step into a space they have been quietly studying for years. We need to go deeper into the implications of what these financial shifts mean for the broader crypto market, especially for assets like XRP that sit at the center of conversations around liquidity, payments, and financial restructuring. When private credit markets tighten and traditional banking channels start showing cracks, the demand for faster, more transparent, and more liquid settlement layers increases. That is where many people in the crypto space believe blockchain-based assets begin stepping into a more serious role, not just as speculative investments, but as potential infrastructure for moving value across borders. The main reason this narrative gains strength is because traditional finance has long dealt with delays, counterparty risks, and high operational costs. So when markets become stressed, the weaknesses of old systems become more visible, pushing institutions to explore alternatives that can offer speed and efficiency. At the same time, it is important to understand that large financial players do not suddenly flip from one system to another overnight. They evolve slowly. They test systems. They build regulatory frameworks. And only then do they start integrating new technologies into their core operations. But the shift usually begins in moments of stress when existing tools no longer feel reliable. That is why the current combination of shadow banking pressures, regional bank vulnerabilities, and growing private credit exposure has created an environment where digital assets are being examined more seriously. Institutions don't always make loud announcements. They often work quietly in the background, evaluating infrastructure, running pilot programs, and testing settlement networks. When we look at increasing partnerships, pilot programs, and cross-border payment tests around blockchain systems, we can see signs of this transition building slowly over time. Another factor we must consider is liquidity. In stressed financial environments, liquidity becomes the single most important asset. Markets that function well during stable times can suddenly freeze when uncertainty rises. That is why institutions look for settlement layers that remain operational 24/7 without relying on physical banking hours or slow interbank messaging systems. Blockchain networks designed for high-speed settlement have a natural advantage here. The more pressure builds in traditional markets, the more attractive instant settlement becomes. This does not automatically mean that all digital assets get adopted. Instead, it means the demand for efficient settlement grows, and only networks with proven reliability begin gaining attention at the institutional level. It is also important to acknowledge how regulation is shaping this entire space. Governments and financial regulators around the world are becoming increasingly aware of the importance of transparency, compliance, and risk control in financial markets. Digital assets that align with these requirements have a much better chance of institutional adoption. This is one of the reasons why some cryptocurrencies consistently appear in discussions around banking, liquidity, and payments. They fit into a narrative of regulated, compliant, and efficient settlement. Whenever financial systems experience stress, regulators tend to accelerate new frameworks to prevent future risks. This can indirectly support the growth of digital asset infrastructure because it pushes the market toward greater clarity and structure. Investors and institutions feel more confident, operating in environments where rules are clear and enforcement is consistent. On top of that, the wider market sentiment plays a major role. When everyday investors start noticing instability in banks or credit markets, they begin exploring alternative stores of value or ways to preserve liquidity. This behavioral shift adds another layer of momentum to the crypto narrative. Public interest increases, discussions around blockchain technology grow, and attention moves from short-term speculation to long-term use cases. It is in these periods that educational content, analysis, and expert commentary become extremely important because people want clear explanations about how new financial systems could function. Looking forward, one of the biggest questions is how quickly traditional financial institutions will transition into using blockchain-based systems for settlement and liquidity. The pressure from shadow banking risks may accelerate this process, but it will still require coordination between banks, regulators, and technology providers. What we can say with confidence is that every period of financial stress creates opportunities for new technologies to prove their value. And if a digital asset or settlement network consistently shows reliability, scalability, and regulatory alignment, then it naturally positions itself as a potential tool in future financial architecture. It becomes clear that the current financial environment is setting the stage for major structural changes. When traditional systems like regional banks, private credit markets, and shadow banking sectors experience pressure, the ripple effects touch every part of the global economy. These stresses don't remain isolated. They spread through liquidity channels, investment flows, and credit networks. This is why analysts across the world are paying close attention to how institutions manage risk during times like these. When cracks begin to appear, financial players start searching for backup solutions, alternative settlement technologies, and systems that can operate even when conventional methods slow down or become unstable. One of the most important things to understand is that financial markets move in cycles. During stable periods, institutions rely heavily on legacy systems because they appear dependable and convenient. But when those systems begin showing weaknesses, the search for new solutions intensifies. This is exactly what we are witnessing now. Private credit markets are expanding rapidly, but this growth comes with increased risk exposure. Regional banks are tightening liquidity, and investors are becoming more cautious. These conditions create a perfect environment for exploring new forms of settlement and liquidity management, especially those that offer speed, transparency, and operational efficiency. Digital assets come into this conversation not because they are trendy, but because they solve specific problems that traditional finance struggles with. For example, cross-border transactions remain slow and expensive in the old system. Settlement delays can create counterparty risks, and liquidity management becomes more complicated when markets are volatile. Meanwhile, blockchain networks designed for fast payments can process value transfers in seconds, operate 24/7, and provide clear transaction records without requiring long reconciliation processes. When financial institutions face stress, the value of these features becomes more noticeable. It is during these moments that digital settlement solutions start to look less like experiments and more like strategic tools. However, it's also important to avoid assuming that adoption happens automatically. Institutions do not move quickly unless they are fully confident in the technology, the regulatory environment, and the long-term stability of the asset. This means the shift toward blockchain-based settlement will be gradual, driven by pilot programs, partnerships, and small-scale integrations. We have already seen early signs of this process across the global financial system where banks and payment providers are testing blockchain for liquidity management and cross-border transactions. These tests might seem minor at first, but they are essential steps toward larger adoption. Another major factor influencing the conversation is regulatory clarity. Whenever financial markets face stress, regulators accelerate reforms. They want to strengthen oversight, reduce risk, and make sure that both traditional and emerging systems operate safely. This regulatory push often benefits digital assets that already align with principles of transparency, compliance, and structured settlement. As clearer rules emerge, institutions become more willing to integrate blockchain technologies because they know what is allowed, what is restricted, and how risk should be managed. Regulatory clarity does not just protect investors. It creates an environment where digital infrastructure can grow responsibly. At the same time, investor psychology plays a significant role. When people see instability in the traditional financial system, they naturally begin exploring alternatives. Some look for safer assets, some seek long-term opportunities, and others simply want to understand how the financial world is changing. This increased interest drives more research, more discussions, and more demand for expert explanations. Channels like Boolean IQ become extremely valuable during such times because audiences want clear, simplified insights without unnecessary hype or confusion. They want to understand not just what is happening, but why it matters. Looking ahead, the most important question is how long these pressures will remain in the financial system. If private credit markets continue to expand without proper risk management, or if regional banks remain vulnerable, the need for faster and more efficient settlement layers will grow even stronger. Digital assets that consistently demonstrate reliability and compliance will naturally gain more attention. But the journey from interest to full adoption will depend on the behavior of institutions, regulators, and global markets over the next few years. It becomes important to tie together all the elements we've discussed and look at what the future may hold for the broader financial system and the role digital assets could potentially play within it. The pressures we're seeing across private credit markets, regional banking sectors, and the entire shadow banking ecosystem are not simply temporary disruptions. They are symptoms of deeper structural imbalances that have been building for years. When these pressures accumulate, the system begins searching for new frameworks, better tools, and more efficient ways to move money. This is where blockchain-based settlement networks start gaining relevance. They offer speed, transparency, and efficiency at a time when the traditional system is struggling under increasing complexity and risk. But it is not only institutions that are undergoing a shift. Retail investors, everyday users, and global audiences are also becoming more aware of how fragile parts of the financial system can be. Whenever banks tighten liquidity or markets enter uncertainty, people begin looking for systems that don't rely on slow processes or outdated infrastructure. This rising curiosity feeds into a larger narrative. The global financial system is approaching a phase where innovation is no longer optional. It is necessary. Technology evolves when existing models reach their limits. We have seen this in telecommunications, transportation, and now we are witnessing it in the world of finance. When markets become stressed, adoption of new technology accelerates because stability becomes more important than tradition. One of the key drivers guiding this shift is the need for real-time liquidity. In a world where value moves instantly across borders, relying on settlement systems that take multiple days creates friction. Financial institutions can no longer afford these delays, especially during periods of volatility. Instant settlement reduces counterparty risk, speeds up transactions, and creates opportunities for more efficient capital allocation. When these features start becoming essential for survival rather than convenience, the conversation around blockchain-based settlement becomes unavoidable. Institutions do not adopt new technologies because they are interesting. They adopt them because they solve urgent problems. Regulation will continue to play a major role in shaping this evolution. Governments across the world are recognizing that digital assets are not temporary trends. They are becoming part of the global financial discussion as regulatory frameworks become more detailed, clear, and structured. Institutions will find it easier to build on top of blockchain technology. This clarity ensures that banks, payment providers, and financial institutions know exactly how to operate, what rules to follow, and how to manage risk within digital networks. For long-term adoption, this regulatory foundation is extremely important. Without it, large-scale integration would remain limited. With it, structured and responsible growth becomes possible. Another important point is the psychological shift happening among investors. People are no longer just focused on speculative gains. They want to understand the utility behind digital assets. They want to know which networks offer real solutions, not just hype. They look for transparency, regulatory alignment, and long-term sustainability. This mindset is crucial because it pushes the market toward more mature, utility-driven adoption. When investors look beyond short-term price movements and begin focusing on real global use cases, the market naturally starts separating strong projects from weak ones. Meanwhile, institutions continue to monitor technological advancements. Even if adoption is slow on the surface, progress is happening behind the scenes. Pilot programs, settlement tests, cross-border experiments, and internal evaluations are all part of this transition. These small steps build the foundation for larger integration in the future. The financial system evolves quietly before it evolves publicly. By the time the shift becomes visible to everyone, the groundwork has usually been in place for years. Looking forward, the biggest takeaway is that the global financial environment is entering a transformative era. Traditional systems will not disappear, but they will increasingly integrate new technologies to remain competitive and resilient. Digital assets that provide real utility, especially those designed for payments, settlement, and liquidity, may find themselves at the center of these discussions. And for analysts, investors, and audiences who pay attention early, this transition offers valuable insight into where the financial world is heading.